Hello everyone, and welcome back to the channel. Today we're diving into the wisdom of one of the greatest investors of all time, Warren Buffett. If you've ever dreamed of building lasting wealth through smart investing, this video is just for you. Buffett, often referred to as the Oracle of Omaha, has transformed his company, Berkshire Hathaway, into a $900 billion powerhouse, achieving an average annual return of over 20% since 1965. But what's his secret? It's not luck or insider tips. It's a set of timeless principles grounded in discipline, patience, and common sense. In this video, I'll break down the core pillars of Buffett's investment philosophy. We'll explore key takeaways you can apply right away, whether you're just starting out or you're a seasoned trader. By the end, you'll have a roadmap to think like Buffett and avoid the common pitfalls that trip up most investors. Stick around until the end for a bonus tip on getting started. If you enjoy this content, please hit that like button, subscribe, and turn on notifications for more finance insights. Let's get into it. First up, let's talk about the importance of sticking to your circle of competence. Buffett's mantra is to invest in what you know. This means putting your money into businesses you truly understand. Why? Because knowledge is your edge in a world filled with noise and hype. Buffett famously skipped the tech boom of the late 1990s because he didn't fully grasp the intricacies of dot-com companies. While others chased internet stocks and faced significant losses, he focused on consumer goods, insurance, and railroads. His famous rule? Risk comes from not knowing what you're doing. So what's the key takeaway here? Audit your own skills. If you're a teacher, consider education stocks. A chef? Look into food and beverage companies. Expand your circle slowly by reading and learning, but never step outside it blindly. This simple habit has saved Buffett, and it can save you from costly mistakes. Imagine avoiding the GameStop frenzy last year because it was outside your expertise. That's the power of competence. Next, let's explore value investing, buying wonderful companies at fair prices. At the heart of Buffett's strategy is the idea of treating stocks like whole businesses, not just ticker symbols. He looks for shares in great companies when they're undervalued, like snagging a luxury car at a discount. Buffett doesn't chase growth for its own sake. He seeks wonderful companies at fair prices. What makes a company wonderful? Strong fundamentals, consistent earnings, low debt, and a management team that treats shareholders like partners. Take Coca-Cola, one of Buffett's longest-held investments. He bought in 1988 because he loved the brand's global dominance and predictable cash flow. Even today, it generates billions in free cash flow annually. Buffett's twist on his mentor Benjamin Graham's philosophy? He's willing to pay a bit more for quality if the business has a moat. Speaking of moats, let's discuss sustainable competitive advantages. Buffett loves to talk about economic moats, the barriers that protect a company's profits from competitors. Think of it like a medieval castle. Without a moat, rival firms can easily invade. What creates a moat? Brand loyalty, network effects, cost advantages, and switching costs. Buffett's portfolio is filled with companies that have strong moats, like See's Candies and American Express. He avoids commodity businesses where competition erodes margins, like airlines. When evaluating a stock, ask yourself, can competitors easily replicate this business? If not, it's a keeper. In a volatile market, having a moat provides peace of mind. Remember, Buffett says, "In business I look for economic castles protected by unbreachable moats." Now, let's talk about the power of time. Patience isn't just a virtue in investing. It's the secret sauce. Buffett's famous advice is, "Our favorite holding period is forever." He doesn't trade stocks like a day trader. Instead, he buys and holds, allowing the magic of compounding to work for him. Compounding is like a snowball rolling downhill. It starts small but grows exponentially. Buffett began investing at age 11 with just $114. At a 10% annual return, that would be worth about $2,000 today. But over 70-plus years, millions. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." During the 2008 financial crisis, while others panicked and sold, Buffett seized the opportunity to buy at discounted prices. The key takeaway? Build a portfolio of 10 to 20 quality stocks and ignore the daily noise. Review your investments annually, not hourly. Use dollar cost averaging. Invest fixed amounts regularly, regardless of market conditions. Over decades,